Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Hey, this is Stan the Annuity Man, and welcome to Fun with Annuities. Today, we're going to talk about a product called Single Premium Immediate Annuity. In the industry, it's called a SPIA, S-P-I-A, which stands for Single Premium Immediate Annuity. It's also called an income annuity, a pension annuity, an immediate annuity. But at the end of the day, this is the granddaddy of all annuity types. This was the one that started it all, and we'll kind of get into the history of it, etc. Now, what I'm going to do is the outline of this podcast really comes from the book that I've written, one of the 7 books on annuities that I've published, and you can buy on Amazon or get it from me, either one you want. And the book's called SPIA Owner's Manual. So it's a Single Premium Immediate Annuity Owner's Manual. I'm actually holding it in my hand. You might hear the pages flip because I want to make sure I'm covering everything, because when I wrote the book, it was all encompassing. It's 45 pages long. It's very easy to read. And before you buy anything, especially an immediate annuity, you need to have this book. So, contact me at stan@theannuityman.com or go to theannuityman.com and sign up and get yours for free, and I'll ship it to you. Or you can go to Amazon and buy it there at your call. But the bottom line is I've already covered it, and what we're going to do is just cover it in an audio version today. But you're going to hear me flip pages because I'm holding it in my hand because I spent a lot of time to concisely put it together. So let's kind of get started. This was the only type of annuity that was sold in the United States until about 1955. So it's been around for a long, long time. The history of the product is fascinating. Single premium immediate annuities, and the word annuity comes from the word annua, A-N-N-U-A. It's a Latin word for payment. And in the Roman times, the Roman Empire created these payments, these lifetime income guarantees for the dutiful Roman soldiers and their families. So, they were getting immediate annuity payments. If you look at Social Security, it is an immediate annuity payment. It really is. It's a lifetime income stream that you can't outlive. And that's really what an immediate annuity is. But with all products that I show people and recommend or talk about, we start with the benefits and the limitations. So let's do that. So first of all, let's start with the limitations, which is always where I like to start. I want people to know the truth about these products. Limitations on an immediate annuity is that it really doesn't have a lot of liquidity. In fact, most of them have none. There are some out there that offer liquidity, but anytime an annuity company offers anything, they're going to lower the guarantee. So, you might have agents say, well, mine does. Well, yeah, but you'll get a lower payout. I always tell people, if you need liquidity, then you're putting too much money into an immediate annuity. The immediate annuity should be a product that is earmarked for pension. And you can set it up for your life, or you and someone else's life, or you and your spouse's life, et cetera. And we'll go through, how to structure it, all the choices that you have. But the one that kills me out there is people say, I hate annuities. Do you really hate pensions? Because this is what a pension is. It's an immediate annuity structure. So there's not a lot of liquidity. There's no market attachment. So there's no upside opportunity. So if you want an investment, don't buy an immediate annuity. The contract is rigid. So, it is what it is. You're going to get your money back if you outlive your life expectancy. You can structure so that 100% of your money goes to the beneficiaries. One of the big things out there, people say, well, I don't want to buy an immediate annuity because when I die, the annuity company, evil annuity company, keeps all the money. Well, that's only one way to structure the product. You can structure it so that you still get a lifetime income, but if your Learjet hits the mountain and you die, 100% of the money goes to your listed beneficiaries. In most cases, with these immediate annuities, they're irrevocable, meaning that you can't call me up 4 months later and say, hey, Stan, send me all the money back. You're going to get the money back, but it's going to be in payment form. And typically, an immediate annuity, the payments are in a static form, meaning the payments are never going to change. Now, you can attach what's called a cost of living adjustment rider, a COLA, or CPIU, Consumer Price Index rider that increases. And that sounds great. But always remember that annuity companies have the big buildings for a reason. They have the big planes and the big logos on the plane for a reason. They don't give anything away. So if you want to attach an annual increase to the income stream, which sounds fantastic, they're going to lower the payment. So you already own the best inflation annuity on the planet, and that is called Social Security, because they raise it based on when they want to get votes. Annuity companies don't care. They're gonna price it in based on your life expectancy, et cetera. So those are the limitations. Limited liquidity, no market upside, rigid contract, irrevocable, and static payments versus COLA. Okay. The benefits, it's a contractually guaranteed income stream for life. You can never outlive it. If you set it up joint life, then your spouse can never outlive it. You can customize how you structure it, meaning that if you want to have the highest payout, that's life only, meaning that when you die, money goes poof. But it does not have to be that way. You can also structure it so you have a lifetime income, okay? And if you die, 100% of any unused money goes to the beneficiaries, and the evil annuity company doesn't keep a penny. You also can structure it for a period certain, meaning, hey, Stan, I just wanted to pay for 10 years. Okay, we can do that, or 15 or 20 or 25 or 22 or 7. Just remember, it's customizable to exactly what you want to achieve. Again, it's a lifetime guarantee. The annuities are the only product category that will pay you for the rest of your life. And also, too, remember this, you're going to hear a lot of pitches out there. Well, my annuity, you need to buy my annuity and turn it on immediately. Let me just tell you this and remember this. Immediate annuities, 99.9% of the time, are going to have the highest contractual guaranteed payout, period, because they're just structured that way. So if anyone's trying to fit a square peg into a round hole and say, buy my indexed annuity with an income rider and turn it on immediately, in most cases, that's just a straight commission play. In most cases. So, if you need income between 30 days and a year, which is the definition of an immediate annuity, the income can start as soon as 30 days from the contract issue date or as long as a year, 13 months, etc. Then an immediate annuity is going to provide the highest contractual payout. As I said in the limitations, you can attach increases, CPIs and COLAs, but that's going to limit the payout. That's going to lower it, okay? Not limit, but lower it, compared to the static form. In most cases, depending on the math, it's a 7 to 9 year break even point if you compare the same exact annuity with a COLA and compared to without a COLA. And in my situation, most of the time when we have a discussion, my clients decide to go ahead and take the static payment, just a time value of money calculation. So these can be set up joint with a spouse. They can be set up joint with anybody, really. You just got to tell me exactly what you want to do. Remember, they are customizable. And immediate annuities are efficient. They're transparent. And in essence, they're a transfer risk strategy that is just unmatched. You're transferring the risk to the annuity company to pay you, or pay you and your spouse, or you and someone else, for the rest of your lives, regardless of how long that is. So you're transferring the risk to pay. So people always say, what's the ROI on immediate annuity? I don't know that until you die. So when you die, I'll go to your funeral, I'll sing a very nice song, and I'll tell everybody the ROI, because up until that point, I don't know. You're transferring the risk. So don't look at immediate annuities as investments and try to compare it to whatever, bonds, whatever. And there's a lot of people out there say immediate annuities versus bonds. That's, to me, Stan the Annuity Man, #1 agent in the country, licensed in all 50 states. That's garbage. Annuities are contracts, so you have to look at it as a contract. One of the other things I like, one of the benefits is they're easy to understand, and there's really no market attachments to them. So those are the limitations and the benefits of the product. So in my opinion, and we talked about the history of these, and they've been around for a long, long time. There's nothing new here. So when people say, I hate annuities, really? Do you hate pensions? Do you hate Social Security? No, of course you don't, which means you don't hate immediate annuities. Now, where financial journalists get caught up, and some of the people that are against them for their own agendas, it's all about opportunity cost. When you put your money into an immediate annuity, you're giving up some opportunity and market opportunity. You have to be fine with that. But that also leads to me and you having a conversation about allocation and proportion. And that's a big deal. Immediate annuities primarily solve for longevity risk. And what that means is outliving your money. It's a very fancy way the journalists like to talk about outliving your money. So, remember, it's will do, not might do. You buy an annuity for what it will do, not what it might do. And the will do for an immediate annuity is the contractual guarantee. And when you get that policy and you look at that number, this is what I'm going to get paid a month, or if you decide to get it quarterly or semi-annual or annually, you can do any. Remember, it's customizable. That number's not going to change. unless you attach a COLA. And we talked about that. That's just going to lower the payment. So nuts and bolts, like how's the sausage made with an immediate annuity? Bottom line is an immediate annuity payment is a combination of return of principal plus interest. Yes, I said that. Return of principal plus interest. So there's a lot of people out there trying to sell these things, and they'll attach a percentage. You're going to get a 7% payout on an immediate annuity. I think that's misleading because people instinctively attach that to a bond payout or a CD payout or a fixed rate annuity payout. No, the 7% is a combination of return of principal plus interest. So I think that's very, very misleading, especially in a low interest rate environment where people are yearning for something higher, right? So when you see that, well, say I'm getting paid out 7% on this immediate annuity, that's really a reflection of your life expectancy, because at the end of the day, the primary pricing mechanism on immediate annuities is your life expectancy, not interest rates. Interest rates play a secondary role, but they don't drive the train. They're not the primary train driver. So people say, I'm trying to time interest rates. Well, you're an idiot. No, you're not actually. You're a nice person, but you're misled. Because in the world that we live in, from financial journalism, financial TV, they're always talking about interest rates. But with annuities and lifetime income stream, it's about your life expectancy when the payment starts. And that's how the annuity companies base the payment. So people always say, well, Stan, if I wait 2 more years to get my immediate annuity, will the payments be higher? Yes, because you're going to be older and your life expectancy is going to be less, which means they're predicting less payments. It's really that simple. Now, with interest rates, and we talk about that, what's the bogey? What do you need to watch? It's really the 10-year Treasury. But the 10-year Treasury, United States 10-year Treasury percentage, that note, really needs to significantly move to move the needle. It's really about life expectancy. What you really need to watch out for is annuity companies moving the life expectancy tables, meaning predicting you're going to live longer. If they do that, there's going to be more payments, which means that the payments will be less. So it's really a true commodity product. There's, 50, 100, I don't know. I represent them all. We quote an immediate annuity. We quote everybody on the planet. I have no idea who's going to finish first. I have no idea anything. All I know is the quote only lasts 7 to 10 days, like a gallon of milk, and then we have to requote it unless you lock it in and start the paperwork. But single premium immediate annuities are commodity products. You have to quote all carriers. I have a system, StanTheAnnuityMan.com or TheAnnuityMan.com, that helps filter all of that out. We have a system where I can punch in your information and then find out through all the carriers across the country the top contractual guarantee. Now, from there, then we have a conversation about claims payability ratings, Comdex scores, etc. But it's, remember, will do, not might do. Buy it for the contractual guarantee. So buying an immediate annuity is similar to buying a plane ticket. Okay, you punch in the number and let's see who has the best contractual guarantee. Don't try to time rates. I mean, that's the biggest thing I can tell people. And I know there's people out there going, well, you're just selling. No, I'm not selling. Okay, this is reality. You just can't time it. And if you wait, let's just say, well, Stan, I'm going to wait for a year. Well, if you wait for a year then to buy the immediate annuity, then you rationally have to factor in the year's worth of payments that you missed if you didn't buy it today. That's not a sales pitch. That's just reality. And immediate annuities and annuities in general, it's all about math. What's the math? Does the math work for you? And I tell people all the time, if you don't need income right now, don't buy an immediate annuity. You can always keep your money in the market, and at the time you need income, then you buy an immediate annuity. So you can do this a couple ways. You can say, hey, Stan, here's X amount of money. Here's a lump sum. How much would that pay? We'll quote that. Or you can reverse engineer it. You can say, hey, Stan, my wife and I need $2,575 a month to fill in an income gap as part of our income floor. How much premium, how much money would it take to create that? So we can reverse engineer the quote either way. So like I said before, you can customize it. You can do life only. You can do life with a period certain. Life only is, when your Learjet hits the mountain, money goes poof. Life with period certain is it's going to pay you for life, but if you die within that period certain, then, in other words, if it's life in 10, it's going to pay you for life regardless of how long you live. But if you die in year 2, you get 8 more years of payments, somebody in your family. Or you can do what's called life with installment refund or life with cash refund, which means that they figure out the period certain to the day of your life expectancy. So it's still a lifetime income guarantee, but 100% of your money will go back to the beneficiaries, either in payment form or lump sum. Payment form is installment refund. A lump sum is cash refund. I like to use immediate annuities as income gap fillers. So, as part of your income floor, your pension, your Social Security, whatever other income things you have, let's fill in that gap. And you can do that a myriad of ways. You can do that with reverse engineering. You can ladder. You can do all kinds of things, to fill in that income gap. So the other thing too, from the standpoint of predator and creditor protection, annuities in general pass outside of probate, but in a lot of states, the ambulance chasing people that run into you with the car and try to see you, they can't get to it, which is kind of cool. Obviously, you don't buy it for that, but it's one of those added benefits that you need to know about. The immediate annuity has a cousin product called a deferred income annuity, which we'll talk about in another podcast, but it's the same structure. The only difference is once you defer past 13 months, once you defer for the income from starting 13 months, then it turns into a deferred income annuity and not an immediate annuity. It's in essence the same thing. So one of the other things I want to talk about quickly is what's called the exclusion ratio. And I know I'm throwing a lot at you, and that's the reason you need to contact me and get the book, because then you can read it on your own terms and then re-listen to the podcast. But an exclusion ratio, when I talked about getting your money back with interest, return of principal plus interest is the payout structure. In a non-IRA setting, and you can use an immediate annuity inside of an IRA or outside of an IRA, but in a non-IRA setting, you're not going to pay taxes on the return of principal, but you'll pay taxes on the interest. So part of that income stream is excluded, i.e. exclusion ratio, from taxes. So that's also something you need to remember. Now, with an exclusion ratio, until you run out of money, in other words, until the run out of money, meaning your account's at zero, the company's still on the hook to pay you for the rest of your life, up until your account goes to zero and you're living forever, it's an exclusion ratio of return of principal plus interest. You're only paying taxes on the interest. Once it goes to zero, then all of that income stream is taxable, even though you're still getting the lifetime income payment. People always say, hey, the account's at zero, but I'm still getting a lifetime income stream. Absolutely. That's the transfer of risk. That's the benefit proposition. I have hundreds and hundreds and hundreds and hundreds of clients that have outlived their life expectancy, are still getting that monthly income stream. And, that goes back to what's my ROI. I don't know what the return on investment is until you die. One thing that we use to look at and it's on my site, theannuityman.com, is you can pull up what's called Comdex rankings, which is a compilation of the 4 primary rating services, which AM Best, Moody's, Standard & Poor's, and Fitch. You can look at those ratings and then look at the Comdex score, which is a compilation of those 4 rating services in an easy to understand 1 to 100 score. Most of the people that are players, most of the carriers that are players in the immediate annuity world are big companies, the names that you are familiar with, and I certainly represent, all of those. Let's see, a couple more things I want to cover, and there's a lot, right? I mean, you're saying, man, you're killing me, Stan, with all this information. That's the reason you need the book, and my blogs and all that stuff will cover, and we can also have these type of conversations. You can schedule a call with me, and I can go over everything with you. But with any annuity, one of the best things I think about the annuity industry has done is what's called a free look provision. I don't care what type you buy. You have the opportunity to get your money back even after the policy has been issued to you. So understand that. That's a really good deal. You can test drive it, get the policy, read the policy. Things might have changed in your life. You can get your money back. There's a time frame that you can do that, but typically it's around 10 to 20 days after you get, depending on the state, 10 to 20 days after you receive the policy. Remember, fixed annuities are regulated at the state level, so every state has a different rule, but you have to know that. Also, too, if you're a youngster, if you're less than 59 and a half years old, you can circumvent those IRS penalties for, the 10% penalty getting your money out through the rule of 72T using an immediate annuity, which is kind of cool. If you're young and you need lifetime income stream, we can structure it so we can circumvent that. Those are kind of the main points that I wanted to go over concerning immediate annuities. I do encourage you to contact me. If you want to get a quote, you can go to my site and just punch in. There's a place there called Get a Quote, right, at theannuityman.com. and you can get a quote, you can get the SPIA owner's manuals, etc. But let's close with a couple of frequently asked questions, just some of the main ones. And I'm actually flipping through the book, which is the reason you need to get it, right? Does the annuity company keep the money when I die with a SPIA? No. Remember we talked about that. You can structure it so that 100% of the money goes to your beneficiaries, even though you're getting a lifetime guarantee. People always ask me, how does an immediate annuity company make money on annuities? I mean, you're giving them their money, they're giving it to you back in either a period certain or a lifetime income stream based on your life expectancy, and they're holding onto the money and they're making money off of that. Nothing risky. They're handcuffed by regulations. They're not doing anything crazy, but they can buy paper that we can't. In essence, they can do things institutionally we cannot as individuals out here to make up for that money. And the reason that life insurance companies have the big buildings is they know when we're going to die, and property and casualty companies are always coming and going, is they don't know when the hurricane's going to hit, right? So is there a perfect age to buy a SPIA? No. It's when you need income. It's when you need to transfer risk. You might not ever need income. I always ask people, call me, say, I think I need an immediate annuity. And I say, well, do you need income? No. Well, then you don't need an immediate annuity. How about that? Remember the two questions. What do I want the money to contractually do? This is when you want to buy any type of annuity. Ask these two questions. What do I want the money to contractually do? And when do I want those contractual guarantees to start? From those two answers, I can give you the type of annuity you need. So if you answer that question, hey, Stan, I need a lifetime income stream to start, I don't know, between now and a year, that's an immediate annuity, right? Those are the answers to the two questions. Remember, you can use it inside of an IRA, outside of an IRA, and you can even buy an immediate annuity inside of a Roth IRA. So what happens then? If you buy it inside of a Roth IRA, then 100% of that income stream is not taxable. So you can do that as well. People ask, how does immediate annuity affect my required minimum distributions? Let's just take an example. If you have a $500,000 IRA and you bought a $100,000 immediate annuity, then the $100,000 immediate annuity income stream would cover the RMDs for that $100,000 immediate annuity. Then you'd have to take RMDs off the other $400,000, if that makes sense. So you can't use the income stream from the immediate annuity as overage to apply to the non-annuity assets, if that makes sense. People always say, what's the best immediate annuity out there? What company do you like? Going back to it, you buy an immediate annuity like you buy a plane ticket, you quote all carriers. There's some great carriers out there, but that doesn't mean they finish first all the time. Sometimes they do, and sometimes they don't. So with that, I mean, there's a lot more that I could go into, but I think we've covered a lot. It's been a fire hose of information. Once again, I do encourage you to ask for or go to my website, theannuityman.com, and sign up to get the SPIA Owner's Manual shipped to you for free. No obligation. Nobody's going to call you. No one's going to hassle you. You also can go to my site and get a free immediate annuity quote. And we'll send you 3 versions. We'll send you, within that one email, we'll send you life only, life with installment refund, and life with 20-year certain to show you how they price all of those. Again, no obligation. No one's going to call you and bug you and show up at your doorstep. So with that being said, I really appreciate you tuning into this and keep tuning into the Annuity Man podcast, because I'm going to go deeper and deeper as I go over the products. Then we'll start going into deeper strategies. This is Stan, the Annuity Man. Thanks for listening to Fun with Annuities. See you next time. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MIGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 Annuity Owner's Manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.